Welcome to Wall Street Confidential on TheStreet.com TV. What is driving this market? You would think that we got what we wanted, 50 points cut yesterday, Jim, and the market just sold off on it. Now, arguably, there's a lot of news today that's disappointing.
Well, I think we'll be up huge. No, the action is the same as the incorrect action that we got last Tuesday after the 75 basis point cut. And I think what people are doing is confusing again the notion of the market with the shift from later cycle to early cycle. I mean, this is a gigantic rally we have in retail, in banks, and home building, and that's what this is about. Earlier this week, the Wall Street Journal talked about how the rate cuts didn't mean anything. Well, the rate cuts are meant to stimulate the early cycle. The early cycle stocks are up far more than I ever thought they would be. Ryland is up from 19 to 31 in 10 days. What you wanted the Fed to do was remove the stress from the system, and that's what they're doing. I think that there's a lot of uninformed analysis of what's really going on. The Fed is now right on course, and as bad as they were, now they're really, they left things open for more cuts. They recognize the dangers in the system. If they had done this in August, we would be up gigantic by now. You have to recognize the undercurrent in the market. This is a market where Sears and Lowe's and Nordstrom's and Home Depot are going to lead us, and a market where you're going to get a tremendous continued reaction from the financials. And you have to have a home builder or RTH or HGX. They've already moved so much that I was hoping that we'd get more of a breather, but we're just not going to, because when the Fed makes a very aggressive move like this, you have to take advantage of even intraday decline like you had at the opening and buy. So please look at the individual groups. This is an RTH-driven rally. The group that I'm looking next is SOX. I don't find anything yet that I really like, but the move is really powerful, and it's much more powerful than I think anyone realizes.
One sector which is arguably the worst right now is those bond insurers, and Wilbur Ross, he's trying to keep their AAA ratings. You think he's just pushing back
No, I think they're leaking. I think they're leaking that he's interested. I don't think he's. I think that they don't want to be taken over. I think eventually they'll have to be done in what's known as a runoff situation, where they will just kind of run their businesses down. If the regulators were to take real aim, they would eliminate the ability for these companies to pay dividends. They're great. They're a windfall, because that's why the Fed has to keep cutting, because otherwise you'll see all the next round of additions to losses for the UBSs and stuff are because the recognition that the counterparty, which is typically either MBIA or AMBAC, is insolvent. And the personal mortgagers, PMI, MGIC, and Radian are also, I think, insolvent. And so as long as that pressure, as long as you have to keep trying to ratchet up the reserves, the Fed will keep cutting and the banks will go higher, because the banks are going to make so much money off their net interest margin.
Understand the cycle change. That is the misconception now.
If you're looking at oil, if you're looking at industrials, if you're looking at the ag infrastructure, you're going to miss. I like those groups. What they do is they tend to sell off for 2 days and then they come back. But this is a very easy to read market. It's just strictly the same as it's always been when the Fed gets in gear. And the people seem to be oblivious to the fact that Bank of America has just gone from 30 to 43. But these are once-in-a-lifetime moves. And I reiterate that anytime you get an opportunity like you had this morning, you got to take it.
All right, Jim Cramer, thank you very much for that. Wall Street Confidential, ladies and gentlemen, on TheStreet.com TV. Stay with us.